Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market Dynamics and AI Tech Pivots, June 25th. This video presents a direct informational narration of the source document. So the market on June 25th presented a really stark contrast. You see, pre-market sentiment reflected May PCE data landing right in line with expectations, along with Micron Technology delivering some very strong earnings. This actually pushed Asian markets, including SK Hynix and Samsung, to initial rebounds. However, right following the US market open, we saw a pretty sharp tech sell-off occur. Our agenda today covers 6 key areas based on the source document. First, market technicals and oil. Second, AI capex pressures. Third, memory chip supply. Fourth, hardware versus software. Fifth, legacy tech pivots. And finally, the Alibaba litigation. Let's jump right into Section 1, Market Technicals and Oil. After that initial pre-market setup, Apple essentially caused a market dive. The source document notes that Apple announced its AI data center expansion actually triggered a severe memory chip shortage, which is causing costs to rise across the board. In response to this, Apple raised prices across its Mac and iPad lines by up to 20%. Now, excluding iPhones, that is their largest global price hike in recent years. As you might expect, this sparked market-wide margin fears regarding the profit margins of other hardware vendors. Looking at this from a technical perspective, the broader market is experiencing a deleveraging phase. The S&P 500 really struggled to fill its April gap, hitting selling pressure right near the gap's lower edge. This was due to ongoing technical selling from pension funds and CTAs. But when the index dipped below the 50-day moving average, it recovered. This indicates that long-term value funds and passive buying established a firm line of support at that specific level. Now, regarding geopolitical developments, just as concerns over the Strait of Hormuz seemed to ease, an unidentified projectile struck a cargo ship in the Gulf of Oman. Consequently, the International Maritime Organization suspended evacuation operations for stranded vessels. As outlined in the source, this direct disruption is impacting regional shipping lanes and adding fears regarding oil supply stability. Moving on to Section 2, AI capex pressures. The source describes the current situation for Meta, Microsoft, Google, Amazon, and Oracle as a structural prisoner's dilemma. Essentially, these M7 tech giants are locked into massive AI capital expenditures. The dynamic is simple but brutal. If they halt AI investments, they risk severe market punishment. This is the dynamic we've previously seen play out when companies like Apple and Google face stock drops over perceived AI lags. So despite mounting costs, the massive spending absolutely has to continue. As the document traces, this creates a clear chain reaction. Step 1. The massive build-out of AI data centers creates shortages and higher costs, specifically for memory chips. Step 2. Apple utilizes a defensive pricing strategy, hiking Mac and iPad prices by up to 20%. And finally, Step 3. This abrupt move triggers market panic over profit margins, spreading across the entire hardware supply chain. That brings us to Section 3, the memory chip supply squeeze. Because those tech giants are funneling so much capital into infrastructure, memory chip manufacturers are generating massive returns. The document highlights that Micron Technology reported an incredible $28.2 billion in quarterly net income, achieving a gross profit margin of 84.9%. To put that into perspective, this profitability outpaces even the most dominant tech giants, including Meta at 81.9% and NVIDIA at 75%. It's clear the immense demand for computing power has completely shifted the fortunes of the memory sector. And here is a crucial timeline. Because tech giants simply cannot slash capex without facing market backlash, AI data center construction is expected to continue accelerating. Memory supply will remain incredibly tight, and the source projects that this upward pricing cycle is going to last all the way until 2027. This securely positions the memory sector as a definitive, long-term hardware play. Let's pivot to Section 4, hardware up, software down. We are seeing a growing divergence right now. The hardware sector is strongly capitalizing on the AI infrastructure wave, while the software sector is actively experiencing capital outflows. For example, Microsoft and Oracle experienced stock drops precisely because the market is just not allocating funds to software at this stage. According to the document, the software sector is projected to remain capital-starved until AI technology fully transitions from this model training phase into large-scale application deployment. To solidify the hardware sector's immediate institutional strength, let's look at Qualcomm.
At their 2026 Investor Day, executives reported major upward upgrades. They now expect their data center business sales to reach $15 billion by 2029. On top of that, they raised their non-handset revenue guidance for fiscal year 2029 from $22 billion up to an impressive $40 billion. This really reinforces the institutional support for the AI hardware narrative.
Now, for Section 5, Legacy Tech Infrastructure Pivots. The source details a surprising revival among former mobile giants. BlackBerry actually recorded a massive 173% year-to-date surge in its stock price. This was driven entirely by a strategic pivot to underlying security software for smart connected devices and autonomous vehicles. This pivot generated positive cash flow for the very first time in 9 years, beating their Q1 revenue expectations and prompting a solid upward revision of their full-year outlook. Nokia is another standout, accumulating a 118% gain this year by transitioning into an AI infrastructure supplier. The document notes that Donald Trump publicly supported Nokia's $30 million U.S. semiconductor investment plan. This is part of a much larger $4 billion U.S. strategy to expand semiconductor testing and advanced packaging. The market interprets this direct backing as a huge endorsement for Nokia's transformation in building optical networks for AI computing. Based on this, JP Morgan actually doubled Nokia's price target from $14 to $21, which implies a nearly 50% upside. As outlined on the timeline, this aggressive target relies on Nokia's indium phosphide wafer plants and advanced packaging capabilities, generating a sustained eruption of orders starting in late 2026 and continuing aggressively through 2027. Finally, Section 6, the Alibaba regulatory litigation. The source document concludes with severe headwinds facing Alibaba. Alibaba has formally filed a lawsuit against the U.S. Department of Defense to be removed from the Chinese military company's 1260H list. The specific restrictive catalyst here is the National Defense Authorization Act. Taking effect on June 30, 2026, it bans the DoD from cooperating with lobbying firms or legal advisors hired by any companies on this list. As a result, top-tier U.S. legal teams have already notified Alibaba they can no longer serve them, which effectively isolates the company's institutional presence in Washington.
Currently, Wall Street institutions remain on the sidelines or are actively shorting the stock due to this severe regulatory blockade. But according to the source, if there is a favorable preliminary court ruling or even a sign of compromise from the Pentagon, short sellers will be forced to aggressively cover their positions. So the explainer leaves us with this thought. Could a break in this regulatory wall trigger a massive retaliatory short squeeze for Alibaba? We will have to watch closely to find out.